While most investors were celebrating modest gains in traditional markets, something extraordinary was happening in the precious metals sector that very few people were paying attention to. Gold just shattered every record in its history, crossing $4,500 per ounce, and silver exploded past $79 for the first time ever. But here's what's really shocking. This isn't just another market rally. This is the largest annual gain in gold since 1979, and silver has surged an absolutely staggering 169% year to date. If you're wondering what this means for your money, your savings, and the global economy, you need to hear this. Let's start with the numbers that are making headlines right now. Gold is currently trading at $4,532.18 per troy ounce. Just to put that in perspective, gold has climbed 72.95% this year alone. That's not a typo. Nearly 73% gains in a single year for an asset that's supposed to be stable and conservative. Silver is even more dramatic. It's sitting at $79.11 per ounce, representing a 169.63% increase year to date. We're talking about an asset that has more than doubled in value. Now, before we go any further, let me explain why this is happening, because understanding the why is absolutely crucial to understanding what comes next. There are three major forces driving this unprecedented surge, and they're all interconnected in ways that could reshape the entire financial landscape. First, we have geopolitical tensions reaching levels we haven't seen in decades. The United States has implemented a blockade on crude shipments from Venezuela, which might not seem directly related to precious metals at first glance, but stay with me. When major oil supply routes get disrupted, it creates a cascade effect throughout global markets. Energy prices become unstable, currencies fluctuate wildly, and investors start looking for safety. And where do they run? To gold and silver, but it doesn't stop there. The ongoing hostilities between Russia and Ukraine continue to escalate, creating uncertainty in European markets and beyond. Then you have recent military actions, including a strike by Washington against ISIS in Nigeria, which signals expanding conflict zones in regions that many investors thought were stabilizing. Each of these events individually would be enough to push precious metals higher, but combined, they're creating a perfect storm of safe haven demand. The second major force is something that directly affects every single person watching this video: interest rates and monetary policy. The Federal Reserve has already begun cutting rates, dropping from 4% down to 3.75% as of December. Markets are now pricing in 2 additional quarter-point rate cuts next year. Why does this matter for gold and silver? Because precious metals don't pay interest or dividends. And when savings accounts, bonds, and other fixed income investments are paying 5 or 6%, gold looks less attractive. But when rates drop to 3%, 2%, or lower, suddenly gold and silver become much more competitive. You're not giving up much yield, but you're gaining protection against currency debasement and inflation. Speaking of inflation, let's talk about the third force. The United States inflation rate has cooled from 3% down to 2.7% as of November. On the surface, that sounds like good news. Inflation is coming down, right? But here's what they're not telling you, that 2.7% is still above the Fed's 2% target, and more importantly, it's cumulative. The damage from the previous years of high inflation doesn't just disappear. Your dollar today buys significantly less than it did 3 years ago, and that trend isn't reversing. Gold and silver are responding to this reality. Let me give you some context that makes this even more interesting. Central banks around the world are buying gold at rates we haven't seen before. China's gold reserves increased from 2,298.53 tons to 2,303.5 tons just in the most recent reporting period. That might not sound like much, but we're talking about nations accumulating massive quantities of physical gold. The United States holds 8,133.46 tons. Russia has 2,329.63 tons. Germany holds 3,350.25 tons. These aren't small numbers. These are strategic reserves that countries are building or maintaining because they understand something fundamental about the future of money. If you're finding this information valuable and you want to stay ahead of these market trends, make sure you're subscribed to this channel. We break down complex financial situations into practical insights you can actually use. Now let's talk about something that most analysts are completely missing: the industrial demand side of this equation, particularly for silver. While gold gets most of the attention as a monetary metal and store of value, silver has a dual personality. It's both a precious metal and an industrial commodity. Roughly half of gold consumption goes into jewelry, 40% into investments, and only 10% into industrial applications. But silver is different. The photographic, jewelry, and electronics industries are massive consumers of silver. With the push toward electric vehicles, solar panels, and advanced electronics, industrial demand for silver is accelerating. Think about this for a moment. Every electric vehicle requires significantly more silver than a traditional car. Solar panels need silver for conductivity. The global push toward green energy isn't just a political movement. It's creating real, tangible demand for physical silver that has to come from somewhere. Mexico, Peru, and China are the biggest producers, followed by Australia, Chile, Bolivia, the United States, Poland, and Russia. But here's the problem. Mining production can't just double overnight to meet surging demand. It takes years to develop new mines, get permits, and bring production online. This supply-demand dynamic is particularly interesting when you look at the price movements. Gold is up 1.15% just in the last day, gaining $51.34. For the month, it's up 8.96%. Silver jumped 5.89% in a single day, adding $4.40 per ounce. Monthly, silver is up 48.09%. These aren't normal movements for metals that are supposed to be stable. Let's compare this to other commodities to understand just how unusual this is. Copper is up 41.67% for the year, trading at $5.77. That's strong, but it's nowhere near silver's 169%. Platinum has surged 172.78% to $2,507.70 per ounce, which is actually even more dramatic than silver. Lithium is up 48.11%. But here's what's interesting. While these industrial metals are also rising, their fundamentals are different. Copper and lithium are pure industrial plays. Their prices rise and fall with economic activity and manufacturing demand. Gold and silver combine that industrial utility with monetary properties and safe haven status. Meanwhile, look at what's happening in energy markets. Crude oil is down 2.52%, trading at $56.93 per barrel. Brent crude is at $60.88, down 2.22%. When oil prices are falling while precious metals are soaring, that tells you something important about market psychology. Investors aren't worried about overheating economic growth. They're worried about instability, currency devaluation, and the need for safe assets. Here's something that should concern every investor. The historical data shows gold has traded in a range from $34.83 at its lowest to $4,549.88 at its highest since 1968. We're now approaching the very top of that range. Some people might say that means it's too expensive to buy now. But consider this. Every previous all-time high eventually became a support level as prices continued higher over the long term. In 1979, during the last major gold bull market, people thought $100 per ounce was expensive. Those who waited for a better entry point missed out on decades of gains. Silver's historical range is even more dramatic. From a low of $3.53 to the current $79.57 peak, we're seeing multiples that dwarf almost every other asset class. The key question isn't whether these prices seem high compared to history. The key question is whether the fundamental drivers that pushed prices this high are going to continue, intensify, or reverse. Let's talk about what happens next, because this is where things get really interesting. If geopolitical tensions continue or escalate, which seems likely given current trajectories, safe haven demand will remain strong. If the Federal Reserve follows through with additional rate cuts, as markets expect, that removes one of the main opportunity costs of holding precious metals. If inflation remains sticky above the Fed's target, which is increasingly likely given structural factors in the economy, real yields stay negative or barely positive, making gold and silver more attractive. But there's another scenario most people aren't considering. What if central banks accelerate their gold purchases? What if major economies start competing to accumulate reserves as confidence in fiat currencies continues to erode? China has been steadily increasing its holdings. India's reserves went from 880 tons to 880.18 tons. These might seem like small increases, but the trend is clear. Nations are diversifying away from dollar dominance. For individual investors, this creates both opportunity and risk. The opportunity is clear. Precious metals are acting as intended, preserving purchasing power during times of uncertainty and monetary expansion. The risk is equally clear. These markets can be volatile. Silver in particular can swing dramatically in both directions. Just because prices are up 169% doesn't mean they can't fall 30 or 40% in a correction before resuming higher. Here's something practical you need to understand. There are different ways to gain exposure to precious metals, and they're not all equal. You can buy physical gold and silver coins or bars, which gives you direct ownership but comes with storage and security concerns. You can invest in exchange-traded funds that hold physical metals, which provides convenience and liquidity but adds counterparty risk. You can buy mining stocks, which offer leverage to metal prices, but also exposure to company-specific risks, operational challenges, and management decisions. Or you can trade futures and options, which provide the most leverage, but also the most risk. Each approach has its place depending on your goals, timeline, and risk tolerance. Someone looking to preserve wealth over decades might focus on physical holdings. Someone seeking shorter-term gains might prefer mining stocks or ETFs. Someone with sophisticated risk management might use option strategies. There's no one-size-fits-all answer. What's absolutely critical right now is understanding that we're in a unique moment in financial history. The combination of record high precious metals prices, persistent inflation concerns, geopolitical instability, and shifting monetary policy creates a complex environment that demands attention and careful strategy. Before we continue, I need to share an important disclaimer. The information presented in this video is for educational and informational purposes only. It should not be considered financial advice, investment advice, or a recommendation to buy or sell any securities or commodities. Precious metals markets can be volatile and speculative. Past performance does not guarantee future results. Always conduct your own research and consider consulting with a qualified financial advisor before making any investment decisions. I am not a financial advisor, and nothing in this video should be construed as personalized financial guidance. Now, let's talk about some specific factors that could influence prices in the near term. The labor market in the United States is showing signs of softening, which supports the case for additional Fed rate cuts. When unemployment rises and wage growth slows, central banks typically ease monetary policy to stimulate the economy. This creates a favorable environment for gold and silver. On the other hand, if economic data remains stronger than expected, the Fed might pause its cutting cycle, which could temporarily pressure precious metals prices. The situation in Venezuela deserves more attention than it's getting. The U.S. blockade on crude shipments isn't just about oil. It's about control of strategic resources and geopolitical leverage. Venezuela has some of the world's largest oil reserves, and any disruption to that supply affects global energy markets. When energy becomes a weapon in geopolitical conflicts, it accelerates the move toward hard assets like gold and silver that can't be sanctioned, blockaded, or manipulated as easily as financial assets. Similarly, the ongoing conflict between Russia and Ukraine has broader implications than many realize. Russia is a major producer of not just oil and gas, but also palladium, nickel, and other critical metals. Sanctions and counter-sanctions create supply chain disruptions that ripple through global commodity markets. This reinforces the strategic value of holding diversified commodity exposure, including precious metals. The strike against ISIS in Nigeria is particularly interesting because West Africa is becoming an increasingly important region for gold production. Countries like Ghana, Mali, and Burkina Faso have significant gold mining operations. Political instability or security concerns in these regions can affect global gold supply, even if the impact isn't immediate. Markets are forward-looking, and any threat to future supply gets priced in quickly. Let me share something about market psychology that's important to understand. When gold and silver start moving higher, it tends to attract momentum traders and speculators who pile in, pushing prices even higher in a self-reinforcing cycle. We saw this in 2011 when silver briefly touched nearly $50 before crashing back down. We saw it in 1980 when gold spiked to over $800. Adjusted for inflation, that would be well over $2,000 in today's money before entering a 20-year bear market. The difference this time is the fundamental backdrop. In 1980, Paul Volcker raised interest rates to nearly 20% to crush inflation, making bonds incredibly attractive and gold irrelevant. In 2011, the global financial crisis recovery was underway, and central banks began tightening policy. Today, central banks are trapped. They can't raise rates significantly without crashing their economies under massive debt burdens. Government debt to GDP ratios are at or near all-time highs in most developed nations. The United States federal debt exceeds $33 trillion. That debt has to be serviced, and high interest rates make that service unbearable. This is why many analysts believe we're in a different kind of precious metals bull market. It's not driven by speculation or temporary fear. It's driven by fundamental monetary conditions that aren't going away anytime soon. Currency debasement is a feature, not a bug, of the current system. When governments need to inflate away debt, gold and silver are among the few assets that maintain purchasing power. If you're still watching and finding this analysis helpful, consider hitting the like button and sharing this video with someone who needs to understand what's happening in precious metals markets right now. It really helps the channel reach more people. Let's talk about some practical considerations for different types of investors. If you're young and building wealth, precious metals should probably be a smaller portion of your portfolio. You have time to ride out market cycles and can afford to be more aggressive in growth-oriented assets. But having some exposure, maybe 5 to 10%, provides insurance against monetary instability. If you're approaching retirement or already retired, the calculus changes. Preserving wealth becomes more important than growing it aggressively. A larger allocation to precious metals, perhaps 15 to 25%, makes sense as a hedge against inflation and market downturns. For those who are already invested in precious metals, the question becomes whether to take profits or let winners run. This is where having a clear strategy from the beginning helps. Some investors scale out as prices rise, taking partial profits along the way. Others hold for the long term, viewing gold and silver as permanent portfolio components rather than trades. There's no right answer, but having a plan prevents emotional decision-making at market extremes. One thing worth considering is the tax treatment of precious metals investments. In many jurisdictions, physical gold and silver are taxed as collectibles, which can mean higher capital gains rates than stocks or bonds. ETFs that hold physical metals may have similar treatment. Mining stocks are typically taxed as regular stocks. Futures and options have their own complex tax rules. This isn't meant to discourage investment, but it's a factor that should inform your strategy and the structures you use. Storage is another practical issue for physical metals. Keeping large amounts of gold and silver at home creates security risks. Using a bank-safe deposit box provides some security, but may not be insured against theft or loss. Private vault storage offers professional security, but comes with ongoing fees. Allocated storage means specific bars or coins are segregated in your name. Unallocated storage means you have a claim on a pool of metal but not specific items, which carries counterparty risk. These details matter when you're talking about significant value. Let's address some common misconceptions about precious metals. First, they're not going to make you rich overnight. Yes, silver is up 169% this year, which is fantastic, but that's unusual and not the norm. Second, precious metals don't produce income. Unlike stocks with dividends or bonds with interest, gold and silver just sit there. Their value comes from being stores of value and hedges, not income generators. Third, market timing is difficult. Trying to buy at the absolute bottom and sell at the absolute top is nearly impossible. Most successful precious metals, investors build positions gradually and hold for years or decades. Another misconception is that precious metals are only for doomsday preppers or conspiracy theorists. Major institutions, family offices, and sophisticated investors hold significant precious metals allocations as part of balanced portfolios. Central banks, the most conservative institutions on earth, hold thousands of tons of gold. This isn't fringe behavior, it's prudent risk management. Some people worry that governments could confiscate gold like they did in the United States in 1933 with Executive Order 6102. While anything is possible, the circumstances today are vastly different. Gold is no longer the basis of the monetary system. There are far more effective tools for monetary policy, and the political backlash from such action would be severe. That said, holding some precious metals outside your home jurisdiction, perhaps in a secure vault in Switzerland or Singapore, provides additional protection if this is a concern. The relationship between precious metals and cryptocurrency is worth discussing because it comes up frequently. Some view Bitcoin and other cryptocurrencies as digital gold, competing for the same safe haven dollars. Others see them as complementary, with crypto appealing to younger tech-savvy investors, while physical metals appeal to more traditional wealth. The data shows both can rise simultaneously when monetary concerns are elevated. They're not necessarily in competition. Both represent alternatives to fiat currency. Both have limited supply mechanisms, though enforced differently. Both have advocates who believe the traditional financial system is fundamentally flawed. Looking at the broader commodity complex provides context for precious metals. Performance. Copper at $5.77, up 41.67%, reflects optimism about infrastructure spending and electrification. Lithium at 111,900 Win per ton, up 48.11%, speaks to battery demand. Steel at $3,091, down 5.45%, suggests construction and manufacturing aren't booming. Iron ore at $106.99, up 2.97%, confirms moderate but not explosive industrial demand. This mixed picture in industrial commodities tells us the precious metals rally isn't just about economic strength, driving all commodities higher. It's selective, it's about specific dynamics affecting gold and silver, monetary metals with safe haven properties. If this were a broad commodity boom driven by economic growth, we'd see oil, steel, and industrial metals surging in sync. Instead, we see precious metals and certain critical minerals rising, while traditional economic indicators like steel and oil remain subdued or declining. The futures market provides additional insights. Professional traders and institutional investors use futures to express their views and hedge exposures. Strong futures positioning in gold and silver with significant net long positions indicates sophisticated market participants expect prices to continue higher, or at least remain elevated. If futures showed heavy short positions or extreme speculation, that would be a warning sign of potential reversal. Current positioning suggests conviction in the uptrend. Exchange-traded fund inflows are another indicator worth watching. When gold and silver ETFs see sustained inflows, It means retail and institutional money is actively entering the market. These aren't just price chasers riding momentum. Many are establishing or increasing strategic positions. ETF holdings are transparent and reported regularly, providing a real-time gauge of investor sentiment. Recent data shows continued inflows despite prices being at all-time highs, suggesting demand remains robust. Mining company performance offers another angle on precious metals outlook. When gold and silver prices rise, mining companies should theoretically see even larger gains because their profit margins expand. A company producing gold at $1,500 per ounce is making much more profit when gold sells for $4,500 than when it sells for $2,000. However, mining stocks face their own challenges, including operational costs, labor issues, regulatory hurdles, and geopolitical risks. Still, for investors seeking leveraged exposure to metal prices, well-managed mining companies can offer compelling opportunities. Before we wrap up, let's talk about some action steps you might consider based on this information. First, educate yourself further on precious metals markets, different investment vehicles, and how they fit into broader portfolio strategy. Second, assess your current portfolio allocation and determine if it aligns with your risk tolerance and outlook. Third, if you decide to invest in precious metals, start with a clear plan, including entry strategy, position sizing, and exit criteria. Fourth, consider dollar cost averaging rather than trying to time a perfect entry, especially with prices at all-time highs. Fifth, ensure any physical metals are stored securely and any paper investments are with reputable institutions. The current precious metals rally is historic, driven by powerful fundamental forces that appear durable. Whether you choose to participate or not, understanding what's happening and why is essential financial literacy in today's complex environment. Gold at $4,532 and silver at $79 represent more than just commodity prices. They represent a statement about global economic conditions, monetary policy, geopolitical risk, and investor sentiment. As we move forward into next year, several key factors will determine whether this rally continues or corrects. Watch Federal Reserve policy closely. Additional rate cuts support higher metals prices. Watch inflation data. Persistent inflation justifies holding real assets. Watch geopolitical developments. Escalating tensions drive safe haven demand. Watch central bank buying. Continued accumulation signals official sector confidence in gold's role. Watch technical levels. Major support and resistance zones matter even in fundamentally driven markets. If you want to stay updated on these developments and more financial market analysis, make sure you're subscribed to this channel and hit the notification bell so you don't miss future videos where we'll continue tracking this story. The precious metals market is sending a clear signal that something significant is happening in the global financial system. Whether prices continue higher from here or consolidate recent gains, the underlying trends of monetary expansion, currency debasement, and geopolitical instability aren't disappearing. Understanding these dynamics and positioning appropriately could make the difference between preserving your wealth and watching its purchasing power erode. The choice is yours, but ignoring what's happening in gold and silver markets means ignoring one of the clearest signals the financial world is sending right now.